So in our last class, we started weighted average cost of capital. And we said that weighted average cost of capital is the overall cost of capital or rate of return for a firm, and it represents the average cost of a company's finance weighted according to the proportion of each source of funds in a company's total pool of capital. And we said when calculating traditional WACC, you can use either book value or market value. We said when you are calculating WACC using the book value, you are expected to add ordinary share capital and reserves together to form the proportion of equity in the company's capital structure. Okay? Then if you are using market value to calculate weighted average cost of capital, it will require you to first calculate market value of individual source of finance. You calculate market value of equity, market value of preference share, and then market value of debt capital. Whichever one you have in the capital structure, you go ahead and calculate it. I gave you the formulas which you are going to use to estimate the market value. And I also informed you that at all times, when you are calculating WACC, you must always use market value to form the proportion of equity and debt, all right? Because market value is more realistic and acceptable to investors, all right? So then thereafter, I also provided you with the formulas that you can use to estimate traditional weighted average cost of capital. So today, what we are going to be doing is to, of course, we also talk about cost of debt. However, today, basically what we are going to be, Phyllis, basically, what we are going to be doing today are purely calculations. I will be very happy if I can complete weighted average cost of capital today. Then I introduce you to project-specific cost of capital. So we are getting almost to the end of WACC. So let's go in straight to begin to solve questions on weighted average cost of capital. For those of you that join in between, that miss maybe first or second classes, all right? So when we are solving question on WACC, I will take time to explain some of the things that we have done in the past, which will also appear again in the calculation of WACC. Okay? Yes, let's start with illustration number 13. Let's have this illustration number 13. I need one of you to help us read. Who is helping us to read it? Or maybe I should take the lead. All right. The following figures have been extracted from the most recent account of Equity PLC, balance sheet as at 30th June 2025. Okay. We're also given ordinary share capital, authorized 4 million shares of ₦1. We don't need authorized shares. What we need is issue shares. Okay. You are given summary of profits and dividends. Then we are told that the current 1st July 2025 market value of Equity PLC ordinary shares is ₦3.25, 27 kobo rather, per share, cum div. Okay. This market price of ₦3.27 is cum div, which means that the current dividend has not been paid. Okay, an annual dividend of 810,000 naira is due for payment shortly. That's tautology. You've already told me that this share price of 3 naira 27 kobo is cum div. Now you are saying again that the annual dividend of 810,000 naira is due for payment. So that's tautology. But in any case, let's move on. The debentures are redeemable at par in 10 years' time. Okay? So because we are given redemption date of 10 years' time, so we can confirm that this debenture is redeemable. It is a redeemable debenture because the redemption date is given. Some of you don't abide by the rules. Their current market value is 77 naira 10 kobo. Forget about the percentage. All right. Annual interest has just been paid on the debentures. There are no issues or redemptions of ordinary share or debenture during the past 5 years. The current rate of corporation tax is 30%. You are required to calculate the cost of capital which Equity PLC should use as a discount rate when appraising new investment opportunities. Discuss any difficulties and uncertainties in your estimates. All right, so this is the question. You are asked to calculate cost of capital, okay, that the company can use to appraise new investment opportunity. So you want to calculate cost of capital. You need to ask yourself what kind of cost of capital. Is it traditional cost of capital? Is it project specific? Or is it weighted average cost of capital of the combined activities? Of course, you can see in this question, we are given information about capital structure because we have ordinary share capital of 3 million. We're also given 7% debenture, all right? So there's no preference share in the capital structure of Equity PLC. So since you are given capital structural information, you are supposed to calculate WACC using the traditional method, okay? Then calculating WACC using traditional method will require 4 procedures. But because we don't have preference shares in this question, then we are going to carry out 3 steps. Step 1 is to calculate cost of equity. Step 2, you calculate cost of redeemable debenture. Then step 3, you calculate weighted average cost of capital. So that's all you need to do. It's as simple as that. Okay? So let's move on. Let's start with step 1, which is to calculate cost of equity. I will stop sharing this, then move to the working notes. All right, please open to the material at your end so that we can follow through together. Okay. The name of the company is Equity PLC. Before that, this is solution to illustration. Illustration, what is that? Let me check. Illustration 13, page 48. Okay. So the name of the company is Equity PLC. So examiner is asking us to calculate cost of capital that will be suitable for Equity PLC to appraise investment opportunities. Therefore, we have identified from the question that we are going to calculate traditional weighted average cost of capital. To do this, we are going to carry out 3 steps because we don't have preference share in the capital structure. So we are starting with cost of equity. So step 1, calculating, we want to calculate cost of equity, denoted as K. Now, for those of you that joined the class in between, you recall, for those of you that started with us, my explanation of cost of equity is that we said cost of equity is the minimum required rate of return expected by the ordinary shareholders. And then there are three methods of calculating cost of equity. Method number one, you can use dividend valuation model. Method two, capital asset pricing model. Method three, Miller and Modigliani formula. Now, we said dividend valuation model is used to calculate cost of equity when information about dividend and share price are given. Okay? And for this purpose, cost of equity will be equal to the current dividend over XD share price, depending on whether or not there is growth in dividend payments. So as you can see from this question, we are given information about dividend and share price, which means that we are going to use dividend valuation model. Then using dividend valuation model, I provided you with two different formulas. A formula where there is no growth in dividend payments and another formula where dividend will grow to perpetuity. All right. So all of this we demonstrated in one of our previous classes. Okay. So in this particular question, since we are given dividend and share price, and then well, that means we are going to use dividend valuation model. We can then come here to say cost of equity equal. Before I put down the formula, I need to go back to the question and confirm whether dividend will grow or dividend will remain constant to perpetuity. All right. When you go to the question as given to you, you will see we are given information about dividend. Go to the income statement where you have profits, summary of profits and dividend. You can see information about dividend from 2021 to 2025. So in 2021, dividend paid was 620,000 naira. So then in 2025, dividend is 810,000. So we are given information about dividend between 2021 and 2025. That means dividend has grown from 620,000 naira to 810,000 naira. Alani, you are disrupting my class. Okay, so dividend has grown from 620,000 naira to 810,000 naira between 2021 and 2025. So this means that there's growth rate. We need to go and calculate it. So we have identified that there's growth. Therefore, the formula to use to calculate cost of equity where there's growth will be equal to current dividend multiplied by 1 plus the growth rate over XDiv, X dividend, share price, plus the growth rate multiplied by 100%. Okay, this is the formula we are going to use to calculate cost of equity. So I would then say cost of equity equal to DO is the current dividend or latest dividend. So the current year is 2025 and dividend in 2025 is 810,000 naira. So dividend is given to us in absolute value. The share price of 3 naira 27 kobo. So you have to use apple for apple. Dividend, we are not given dividend per share. So in that case, in order to ensure that you are using this, you are using apple for apple, the same kind of so that means we need to is either you convert your total dividend of 810,000 naira to dividend per share, or you convert the share price to absolute value. Whichever one you do, you still get the same answer. We have demonstrated this in the past. So in our own case, I want us to use par value. Okay, so that means we need to go and calculate dividend per share. Okay, so this would be for my cost of equity, cost of debt, WACC. Then my third page will be for workings. So working number one, we want to calculate dividend per share. DPS. So dividend per share is calculated as total dividend over number of ordinary shares. Number of ordinary shares. So in 2025, total dividend is 810,000 naira over number of shares. When you go to the balance sheets, of Equity PLC, we are given issue shares. Like I mentioned earlier when I was reading the question, you don't use authorized share. The maximum shares that Equity PLC can issue out is 4 million shares. So far, as of today, what has been issued out is 3 million shares. So it is the issue share that you are going to use. You don't use authorized shares. So 3 million shares. Number of shares is 3 million. So this will give us dividend per share, 810 divided by 3,000. What do we have there? 810 over 3,000.
27 kobo.
That's 27 kobo. Thank you. 0.27 or 27 kobo. So dividend per share is 27 kobo. Again, I will then go from there. DO is the current dividend of 27 kobo per share. Now, 1 plus growth rates. We have identified from the question that there is growth in dividend payments because dividend has grown from 620,000 naira to 810,000 naira between 2021 and 2025. Therefore, we need to estimate the growth rate. You can see, examiner did not ask you to calculate growth rate. It is implied in the question. You must know the next thing to do. And that's why the question, you are the one that will be probing the question, and the question will be directing you. Okay? So you must know what you should look out for. And of course, for you to be able to do this, you must understand the concept. You need to understand the underlying concept or principle. Because if you don't know it, certainly you will know the variable that you should look out for in a question. So working number 2, we want to calculate growth rates. Denoted as G. Now, when I was explaining the concept, I told you there are 2 methods of calculating growth rates. Method number 1, you can use historical pattern of dividend payment, or what we know as averaging method. The second method is the Gordon growth model. And we said that the historical pattern of dividend payment is used when past information about dividend payment are given in a question. And then the Gordon growth model is used for calculating growth rates when information about earnings or profit after tax and then capital employed are given in a question. So in this particular question of Equity PLC, examiner has given us the history of dividend paid between 2021 and 2025. That means we are supposed to use historical pattern of dividend payment to calculate your growth rate. So using historical pattern to estimate growth rate, I gave you 2 different formulas. The first formula is n minus 1, into square root latest dividend over dividend paid in the first year, all minus 1. Then the second formula is n into square root latest dividend over dividend paid in the first year, all minus 1. And I mentioned that the first formula is used when past information, okay, when information about dividend paid across all the years are given to you, that's when you use n minus 1. Okay, the other one is when you are given information about the current year dividend and dividend paid in the first year alone. All right, so in this question, we are given information about dividend payment across all the 5 years between 2021 and 2025. Therefore, we can then say growth equal to n minus 1 into square root latest dividend over dividend paid in the first year, or minus 1. So this is the formula for calculating growth rate, which we have done in the past. Okay, so G would then be equal to between 2021 and 2025, that's 5 years. So here will be 5 minus 1 into square root. Dividend paid, the current year dividend is 810,000 naira. That's 2025. 2025 is the current year. So dividend paid in the first year is 2021, which is 620,000. Then minus 1. There's no need for you to be doing step 1, step 2, to be doing line by line. So when you know how to use, if you know how to use second function in your calculator, put everything in your calculator, get your final answer. This is working. You don't need to be doing one by one. It's a waste of time. However, if you don't know how to use second function in your calculator, then you need to convert this mathematically. You can say G equal to 810,000 over 620,000. All of this raised to power. Now, 5 minus 1 is 4. Therefore, I would then say 1 raised to power 1 over 4, or minus 1, that you multiply with 100%. So 1 divided by 4 will give us 0.25. Therefore, from your calculator, 810,000 divided by 620 equal, then raised to power 0.25 equal, then minus 1 equal, multiplied by 100% equal to 6.91. So the growth rate is equal to 6.91%. Approximately growth rate equal to 7%. So dividend has grown by 7% between 2021 and 2025. So this is how to estimate growth rate when you are given the history of dividend payments. Okay, so let's go and put it in our formula. Growth rate is 7%. 1 plus 7% will give us 1.07 over X dividend share price. Let's go back to the question. We are looking for X dividend share price. According to the question in the last paragraph, you are told that the market value of equity PSC ordinary shares is 3 naira 27 kobo per share cum div. So you are given a cum div share price. It means that the current dividend has not been paid. Therefore, we need to convert the cum div share price to ex div share price, because you don't use cum div share price to calculate cost of equity. It has to be ex div share price. The dividend must have been paid before you calculate your cost of equity. In this particular question, the current year dividend has not been paid. Therefore, that 3 naira 27 kobo, we can't use it because it is cum div. All right, so let's go and make adjustments. Working number 3 now. Working number 3, we want to calculate ex-div, ex-dividend, share price. Okay, the ex-div share price is the cum-div share price of 3 naira 27 kobo less the current dividend. We have calculated dividend per share to be 27 kobo, 0.27. So the difference is 3 naira. This is X dividend share price. So you can see the way we are making the adjustment. And that's what I was telling you the other time. You must know what is next. All the variables you are looking for, you must know how to get it in a question. Okay? Anyone you don't have, any variable that you are looking for your calculation and that is not readily available, go and make adjustments. Then you come and post. Okay? So 3 naira is the share price, ex-div share price. Here is 3 naira plus the growth rate of 7%. All of this multiplied by 100%. Therefore, cost of equity will be equal to 0.27 multiplied by 1.07 equal divided by 3 equal plus 0.07 equal multiplied by 100% equal to 15.41%. Approximately, this is 15%. Okay, that's 15%. The cost of equity the cost of equity PLC is approximately 15%. Somebody is sending a chat. Let me check. What's 16.63? Lekon, what do you mean by 16.63%?
So when I calculated it, I got 16.63.
Okay, let me do it again. Maybe I made mistake.
Same thing I'm getting with Lekon.
Okay, 0.27 multiplied by 1.07 equal, then divided by 3 equal plus 0.07 equal. Oh, it's true. Multiply by 100% is 16.63. How did I get 15% in the first place? So that's approximately 17%. Thank you for that observation. Yeah. Okay, so let's move on. Now we have computed cost of equity. Step 2 is to calculate cost of redeemable debenture. So, step 2, calculating cost of redeemable debenture, denoted as KD. Why are we calculating cost of redeemable debenture? In the question, we are told that the debenture will be redeemed in 10 years' time. Because you are given a redemption date of 10 years' time, therefore, we can confirm that this is a redeemable debenture. If the redemption date is not given to us, we are going to treat it as cost of irredeemable. All right? So, and we said that calculating cost of redeemable debt, you are simply going to calculate internal rate of return. Anytime you want to calculate cost of redeemable debt, just go ahead and calculate internal rate of return. 2 steps. Step 1, assume 2 discount rates that will produce 2 opposing NPV, a positive and negative NPV. Then step 2, calculate cost of redeemable debt using internal rate of return formula. It's as simple as that. All right. No matter how big is the question, it's the same thing. It's the same procedure. All right. So we are assuming 10% at the first instance. We are going to use this 10% to calculate NPV. So create a column for year, description of items, cash flow, discount factor at 10% for a start. Then we are going to have present value. So year zero. In year zero, we have current market value of the debenture. We then go back to the question. We want to identify the current market value of the debenture. According to the question, we are told that the debenture are redeemable at par in 10 years' time. Their current market value is 77 naira 10%. And I told you just to ignore the percent. It's just 77 naira 10 kobo. Annual interest has just been paid. The company has paid the debenture interest. Therefore, the 77 naira 10 kobo represent X int price. No need to make any adjustment again. It's already X int. Okay? So let's go and put it down. Here will be 77.10. Put it in bracket. We are calculating NPV. Then I will go back to the question. When are we redeeming this debenture? We are told it will be redeemed in 10 years' time. Therefore, this simply means that Equity PLC will pay annual fixed interest from the first year to the last year. That is from year 1 up to year 10. So here will be year 1 to 10, fixed interest. How much is the interest we are going to pay? Let's go back to the question and check. Okay. Now, when you look at your balance sheet given to you, we are given 7% debenture. That 7% is the interest rate, is the coupon payment, is the coupon rate. Okay. The 7% is the coupon rate on this redeemable debenture. So before I put it down, I need to confirm from the question if tax is paid, if there is tax. So we are given corporation tax of 30%. So tax rate is 30%. Remember, debt is a cheaper source of financing because of tax deductibility benefits. So because of tax, the cost that the company will pay will be lower relative to when there is no tax. So instead of me to use 7 here, 7% of 100 naira will give you 7 naira. So just forget about the percentage. So instead of me to use 7 here, no, because you are given tax rates, I'm not going to use 7. All right, I need to adjust for tax. So we need to go and calculate post-tax interest. You see the way we are making our adjustments? That's what is expected of you. Working number 4, we need to calculate after tax, or what we call post-tax interest. So post-tax interest is calculated as interest multiplied by 1 minus tax rate. So interest rate is 7%. That is 7% of 100 naira will give us 7 naira. Multiplied by 1 minus tax rate. Tax rate is 30%. So that means we are supposed to account for 70%. But because of, let me just do 1 minus 0.40. On the day of your exam, no need to be doing this. It's a waste of time. You already know, sorry, this is 30%. So you already know that tax rate is 30%. 1 minus 30% is 70%. So you don't need to be doing 1 minus 30. Just put 0.7. So this will give us 7 multiplied by 70%. So this is 4.9. Like I said, no need to be stressing yourself to be doing 1 by 1 like this. Once you just bring out your calculator, do 7 multiplied by 0.7, you get your answer and move on straight. So, like I said, instead of using 7, we are going to use 4.9 because your interest must be after tax. Anytime you are given tax rates and you want to calculate cost of redeemable debt, you must adjust for tax. So here is 4.9. Okay. Then, finally, in year 10, which is the final year, this debenture will be redeemed. Okay. I can then say redemption value. Then you need to ask yourself from the question, how are we going to redeem the debenture? Is it at par, at premium, or at a discount? So examiner told us in the question that the debenture are redeemable at par in 10 years' time. At par means 100 naira. Remember, debenture is always quoted at 100 naira per unit, except if examiner wants you to use a different number. At times, they can ask you to use 1,000 naira per unit. But in this question, we are told it's at par. That means at 100 naira. So here will be 100. So the next thing we need to do is to get the discount factor for the respective years. Okay, let me complete my table. All right. On the day of your exam, anytime you draw a table, you must ensure you complete your table. Don't do one side and leave the other side. That's not a good presentation. Because you are in a hurry, you just want to draw table anyhow and then move on. You never can tell the person that will mark your script may be a detailed person, and those little things can't. Minus half. When you have so much minus half, that's a lot at the end of the day. So 1 mark can take you to the next level. Okay. Discount factor for year 0 at 10% is 1. 1 multiplied by 77.1 will give us 77.10. Then we need to calculate annuity factor of year 1 to 10 at 10%. How do we do this? Quickly, I need you to give me an answer. So you can just say, we are using 10%, so 1.1 raised to power 10 minus equal minus 1 equal divided by 0.1 equal 6.145. This is 6.145. That's the annuity factor of year 1 to 10 at 10%. Please ensure you try it at your hand. Make sure you get the same answer. If you don't get the same answer, let me know. Then we need to calculate discount factor for year 10 at 10%. This will be 1.10 raised to power 10 minus equal 0.386. 0.386. So let's multiply to get the present value. Okay, 4.9 multiplied by 6.145 equal 30.11. 30.11. Then 100 multiplied by 38 multiplied by 0.386. This will give us 38.6. So we need to get NPV now. So to get the NPV, we are starting with the positive present value. So 38.6 plus 30.11 equal, then minus 77.1 equal 8.39. Okay, this is 8.39 minus 8.39. Somebody is pressing and let me check. Okay, I've got down the end. No problem. Now, we assume 10%. We got a negative NPV of 8.39. So let's assume a lower discount rate that will produce a positive NPV. So let's assume 5. Okay? So discount factor for year 0 at 5% will still remain 1. 1 multiplied by 77.1, that's 77.10. Then we need to calculate annuity factor of year 1 to 10 at 5%. That will be 1.05 raised to power 10 minus, okay, minus 1 equal divided by 0.05 equal 7.722. Here is 7.722. Then discount factor for year 10 at 5%. That should be 0.614. Let me confirm. 1.05 raised to power 10 minus equal 0.614. Here is 0.614. Let's multiply to get the NPV, to get the present value. Okay, 4.9 multiplied by 7.722 equal 38.84. Here is 38 points. Is it 38.84? Let me confirm. 37.84 rather. 37.84. Then here will be 61.4. 100 multiplied by 0.614. That's 61.4. So to get the NPV, we are going to add 61.4 plus 37.84 equal minus 77.1. That's 22.14. 22.14 positive. All right. We assume 10%. We got negative NPV of 8.39. We then reduce to 5% discount rate, and we have a positive NPV of 22.14. Now that we have two opposing NPV, we can then proceed to calculate cost of redeemable debenture using internal rate of return. So KD, that is internal rate of return, is calculated as lower discount rate plus net present value of the lower discount rate over net present value of the lower discount rate plus net present value of the higher discount rate. All of this multiplied by higher discount rate minus lower discount rates. So cost of redeemable debenture will be equal to 5% is lower than 10%. So here will be 5 plus NPV of the 5, 22.14 divided by 22.14 plus NPV of the higher discount rate, 8.39. All of this multiplied by higher discount rate of 10% minus lower discount rate of 5%. All right? Put it in your calculator, get the final answer. So starting from the denominator, 22.14 plus 8.39 equal 30.53. So 22.14 divided by 30.53 equal, then multiply by difference between 10 and 5, which is 5, equal, plus 5, equal, that's 8.63. So cost of redeemable debenture is 8.63%, approximately 9%. KD is approximately 9%. Okay. All what we have done in the past is what we are doing now again. Okay. So cost of redeemable debts is approximately 9%. Now that we have computed cost of redeemable, somebody is sending a chart. Let me see. Okay, thank you, Lekon. All right. So we are done with step 1 and step 2. Final step is to calculate cost of weighted average cost of capital. So I would then say calculating or estimating weighted average cost of capital, denoted as KW. So if I like, I can use formula to calculate my WACC. If I like, I can use the table. Whichever one I use, I will get the same answer. And I advise you, get used to the formula, because when you get to project specific, it's the formula that you are going to be using. So using the formula, I will say equity value divided by equity plus debt. We don't have preference share. There is no preference share. So multiply by cost of equity plus market value of the debenture over equity plus debt value multiplied by after tax cost of debt. Okay, so this is the formula for calculating weighted average cost of capital. So in this case, from this formula, E represents equity value, D is debt value. So that means we need to go and estimate market value of equity and then market value of debt. Remember what I told you last week? When you are calculating WACC, always use market value to form the proportion of equity and debt. You don't use book value, except examiner asks you to use book value, because market value is more realistic and is the most acceptable price by investors. Okay, and that's why when you are calculating your WACC, you must use the price that reflects current information, current market information, or market condition. Okay, so we need to go and calculate market value of equity and debt. That will take us to working number 5. Market value. So starting with equity, market value of equity is calculated as number of shares multiplied by XD share price. If number of shares is not given, it will be calculated as share capital divided by nominal price multiplied by XD share price. So in this question, we are given number of shares, okay? So multiply by XD. Share price. So equity value will then be equal to, let me manage the space. So number of shares is 3 million. 3 million ordinary shares. XD share price, we calculated 3 naira. So equity value is equal to 9 million naira. Then we calculate the market value of the debenture, denoted as D. Market value of debenture or market value of debt is calculated as nominal value multiplied by X interest price divided by 100 naira. Okay, so D will then be equal to, I will go to the question. What's the nominal value of the debenture? According to the question, you are told that the nominal value in the balance sheet, the nominal value is 1,300,000 naira. Okay, here is 1,300,000 multiplied by X int price. We are given X int price of 77 naira 10 kobo. Then divided by 100 naira. We divide it by 100 naira because debt is always quoted at 100 naira per unit. Okay. Since this is less than 100 naira, that means the price is at a discount. Okay, the price is quoted at a discount. If it is more than 100 naira, that means it's quoted at a premium. Okay. So D will then be equal to, from my calculator, 0.771 multiplied by 1,300,000. That's 1,02,300 naira. 1,02,300 naira. So we need to get total market value. Total market value of equity and the debt will be equal to equity value is 9 million naira plus debt value of 1,02,300. Total market value is 10,02,300 naira. So that's that. This is what we are going to use to form the proportion of equity and debt. So equity is 9 million divided by total, which is 10 million, 2,300. No need for you to come and be doing 9 million plus 1,02,300 again. So that's why we calculated that total. So multiply by cost of equity of 17% we calculated. I think it's 17. Yes, it's 17. Initially, I wrote 15 before Lincoln caught my attention. Okay. Then plus market value of the debenture, 1,02,300 naira divided by total market value of 10,02,300 multiplied by after tax cost of debt. We calculated 9%. Please, there is no need for you to come and be doing 1 minus tax again. We've already adjusted for tax before we arrive at the 9%. So no need for you to come and do 1 minus tax. If you multiply with 1 minus tax, that means you are double dipping. You are treating tax twice. So you have to avoid that. Okay? We've already adjusted for tax when we were calculating the cost of redeemable debenture. Okay, this is what I mean by that. Look at, we've already adjusted for tax. This is the 1 minus tax. We've already adjusted for tax. So because in your formula here, you also have 1 minus tax. Student may think that, okay, I need to come and adjust for tax here again. No, we've already adjusted for tax before we arrive at the 9%. So you have to ignore the formula. If possible, don't put 1 minus tax if you have already adjusted for tax. But when you calculated your cost of redeemable debenture, if you did not adjust for tax, when you get to this place, you must adjust for tax. Okay? So that's that. Let's move on. Then from the left, this is 9 million naira divided by 10 million, 2,300. No, that's not complete. 0,2,300. Okay? Equal. Multiply by 17. Equal. That's 15.29 or 15.30. 15.30%. Then on the other side, 1,02,300 naira over 10,02,300 naira multiplied by 9 will give us 0.9, 0.90%. When you add the two together, that will give us 16.2. 16.20%. Therefore, the WACC of equity PLC is approximately 16%. So if I don't want to use, oh, okay. Okay, I don't have space again. I wanted to use tabular method, but let me see. If I don't want to use formula, I can as well use tabular method. All right. So using tabular method, I will create a column for type of the securities. So here will be the market value. Then we are going to have the cost of capital of individual, the source of individual capital, or you call it proportion. Then here we have hash total. Okay. So we have two types of security, equity, and then 7% debenture. We calculated market value of equity to be 9 million naira. Market value of the debenture to be 1,02,300. And we have total of 10,02,300. This is total. Okay. Then we calculated cost of equity to be 17%. That's 0.17. We calculated cost of redeemable debenture to be 9%, 0.09. So to get the hash total, multiply the market value with the cost of capital, cost of individual capital. So here will be 9 million multiplied by 0.17 equal, that's 1,530,000. Then 1,02,300 naira multiplied by 0.09 equal, that's 9207, 90,207. Okay, then you add it up plus 1,530,000. 1,530,000. Okay, equal 1620. 1620, then 207. So to now get the WACC, WACC is calculated as hash total over total market value multiplied by 100%, which is equal to 1620, 207 over 10,02,300 multiplied by 100%. So WACC will then be equal to, from my calculator, 1620, then divided by 10,02,300 equal, multiplied by 100% equal, that's 16.198, 16.20. So when you approximate it, that's 16%, 16.20%, approximately 16%. So whether you use the tabular method or you use the formula, you are expected to get the same answer. Okay, so that is that. That is that. Let me know if you have any question on this. If not, let's move to another example. Any question? Is there anything doing you why that you don't understand? Let me know. Okay. If there's no question, let's have another example. Let me stop sharing this. All right. Let's solve example number 12. We have 2 more to go. Let's solve example number 12. Okay. In fact, we have 3 more to go. That means we need to be fast. We need to be faster than before. So let's solve this example number 12. Still on the same page 47. Page 47. I need one of you to read. I've been the only one talking since. So I want to hear your voice. Who is helping us to read? Page 47, illustration number 12. Yes, who is helping us? Okay, let me call one of you. Yeah, let me see. Yes, Adejimi Lekan Favor. You want to try?
Yes, sir.
Okay, go ahead.
The management of Abalkaliki PLC has tried to decide on a cost of capital to apply on of the evaluation of investment projects. The company has an issued share capital of 500,000 ordinary share of 1 naira, currently quoted at 1.717 naira per share cum div. It has also issued 200,000 naira of 10% debenture, which are redeemable at par in 2 years time, and have a current market value of 105.3%, and 100,000 naira of 6% preference shares, currently quoted at 40 kobo per share. The preference dividend has just been paid, and ordinary dividend and debenture interest are due to be paid in the near future. The ordinary share dividend will be 60,000 naira this year, and the directors have publicized their view that earnings and dividend will increase by 5% a year into indefinite future. Sorry. The fixed asset and working capital of the company are financed by the following: ordinary share of 1 naira each at 500,000, 6% preference share of 1 naira at 100,000, debentures at 200,000, reserves at 380,000. The company tax rate is 40%. Then required, advise the management of Abakaliki PLC on the appropriate cost of capital to use for its investment.
Thank you, Lekan. Yes, that is the question. You are required to calculate cost of capital that will be appropriate. So that will be appropriate for Abakaliki PLC to appraise its investment. So you want to calculate cost of capital. So you can see from the balance sheet given to us, this capital structure, we have ordinary share capital, preference share capital, as well as a debenture. So which means that we are going to calculate traditional WACC. So without wasting more time, let's quickly dive in so that I'll be very happy if we can solve all the relevant questions that we want to solve today, so that we know in our next class, possibly we just start project-specific cost of capital. Okay. All right. This is solution to illustration 12. Page 47. The name of the company is Abakaliki PLC. Okay, so we want to calculate WACC, traditional WACC. And in the capital structure, we have ordinary share capital, preference share capital, and then debt capital. So that means we are going to follow 4 steps. So step 1 is to calculate cost of equity. So before we put down the formula to calculate cost of equity, we go to the question and confirm whether we are given growth rate or not. In the question, we are told that dividend will grow by 5%, okay, a year into indefinite future. So there is growth rate given to us, no need to sweat. So I will then come here, cost of equity equal to cost of equity equal to current dividend multiplied by 1 plus the growth rate over xdiv share price plus the growth rate multiplied by 100%. All right, so cost of equity equal. I will then go to the question, what's the current dividend given to us? According to the question, in the second paragraph, you are told that the ordinary share dividend will be 60,000 naira this year. All right, so we are given total dividend of 60,000 naira. So we may want to convert that. If you are using par value, we need to convert the 60,000 naira to dividend per share, because your share price is 1 naira 17 kobo, cum div. So if you want to use absolute value, you need to convert your share price to market value of equity. But if you are using par value, then you need to convert the total dividend of 60,000 naira to dividend per share. Whichever one you do, you are going to get the same answer. So in our own case, we are going to use par value. So this page, the second page, then third page will be for our workings. Hopefully this will be sufficient. We manage it. So working number 1, we want to calculate dividend per share. So dividend per share equal to total dividend over number of ordinary shares. So we are given total dividend of 60,000 naira. Number of ordinary shares is 500,000 according to the question. Therefore, what do we have here? 60 divided by 500, that should be 12 kobo. Let me confirm. 60 divided by 500. Yes, that's 12 kobo. 0.12 or 12 kobo. So dividend per share is 12 kobo. Now, also working number 2, we are going to need xdiv share price, because we are told that the share price of 1 naira 17 kobo is cum div. That means we need to convert to xdiv share price. X dividend share price. Which is calculated as cum div share price of 1 naira 17 kobo less current dividend of 12 kobo. Current dividend, we calculated 12 kobo. So difference is 1.05. This is xdiv share price. So let's go back there and complete our cost of equity. So current dividend is 12 kobo, 0.12. We are given growth rate of 5%. So 1 plus 5% is 1.05. We have calculated ex-div share price to be 1 naira 5 kobo plus the growth rate of 5% given to us. All of this multiplied by 100%. Okay? Therefore, cost of equity is equal. Bring out your calculator. 0.12 multiplied by 1.05 equal divided by 1.05 equal plus 0.05 equal, then multiply by 100% equal to 17%. Cost of equity of Abakaliki is equal to 17%. Step 2, we calculate cost of preference share. Costs of, now, you need to go back to the question and confirm what kind of preference share is this one? Is it redeemable or irredeemable preference share? According to the question, you are told that 100,000 naira or 6% preference shares currently quoted at 40 kobo per share. So you are not given the redemption date for the preference share. Therefore, it will be calculated as cost of irredeemable preference share. Okay, and the cost of irredeemable preference share is computed as the ratio of fixed dividend to ex-div share price. Irredeemable preference share, denoted as KP. All right, so cost of irredeemable preference share is the ratio of fixed dividend divided by ex-div share price multiplied by 100 over 1. So KP equal. So go back to the question. To get your fixed dividend, you are given 6% preference share. And I told you that the preference dividend is the nominal rate multiplied by nominal value. Nominal value, according to the question in the balance sheet, is 1 naira. 6% preference share of 1 naira. So that 1 naira is the nominal value. The interest that the company will pay is 6% of 1 naira, which is 6 kobo. So here will be 0.06 divided by the market value of the preference share, the share price of the preference share. So according to the question, we are told that the preference dividend has just been paid. The company has paid preference dividend. So what that means is that the share price of 40 kobo per share is already ex-div. Okay, so here will be 0.40, then multiply by 100 over 1. So what do we have here? 6 over 40. Multiply by 100%, that's 15%. Okay, so the cost of irredeemable preference share is 15%. Step 3. Can I manage this space? Let me see. Step 3 is to calculate cost of redeemable debenture. Cost of redeemable. I doubt if this table will be sufficient. Let me see. Let me move to the next page. I don't want to manage space. 3. Calculating cost of redeemable debenture denoted as KD, which means we are going to calculate internal rate of return. Why are you calculating cost of redeemable debenture? Because in the question, you are given redemption date to be 2 years' time. You are given redemption date, and that's why we are calculating cost of redeemable debenture. Okay, so we assume two discount rates that will produce two opposing NPV. Go to column for year, description of items, cash flow, discount factor at 10%. We are going to have present value. Year zero. Here we have the current market value of the debenture. According to the question, let's go back. What's the market value of the debenture? We are told that current market value of 103.3%, sorry, 105.3%. So 105 naira 30 kobo is the market price of the debenture. And we are told in the question that debenture interest is due to be paid in the near future. So since debenture interest has not been paid, it means that the 105 naira 3 kobo or 30 kobo represents cum int price. We need to convert it to X int price. So let's go and do working number 3. We calculate cum X int price rather. X interest price. So this is computed as cum interest price of 105 naira 30 kobo less the interest that is outstanding. What's the interest rate? According to the question, the interest rate, the coupon rate on the debenture is 10%. Okay? The coupon rate on the debenture is 10%. So if interest is 10%, I would then come here. 10% of 100 naira is 10 naira. So 10 minus 105.3, that's 95.3. This represents the X int price. That's the adjustment we need to make. So now that we have the X int price, I can then proceed to calculate my cost of redeemable debenture. Here is 95.3. Okay. Then the redemption date is in 2 years' time. That means the company will pay annual fixed interest for the next 2 years. So year 1 to 2, fixed interest. I will go back to the question. Interest rate is 10%. So I need to confirm if I'm given tax rates. Yes, in the question you are given a tax rate of 40%. Therefore, I cannot use 10. I have to go and calculate after tax interest. Okay, working number 4. Post-tax interest. Post-tax interest is interest multiplied by 1 minus tax rate. So interest is 10%, tax rate is 40%, so you are supposed to account for 60%. So here is 6 naira. All right. So I will then come here, I'll put 6 naira. Now, you have to be very careful. At times, examiner will tell you that tax is payable 1 year in arrears. That means the interest you are supposed to pay in the first year because of tax, will be paid in the second year. So there will be 1 year lag. But in this question, you are just given tax rate of 40%. You are not told whether it is in arrears or in the current year. So where you are not told, you are going to assume it will be paid in the current year. And that's why we are doing year 1 to 2. All right. Later on, before the end of this class, I'm going to show you a question whereby you are given tax in arrears. Tax is paid in arrears. You see the way I treated it. I will show you later on in the golden book. But for now, let's move on with the question we are solving. Now, in year 2, in the final year, this debenture will be redeemed. Therefore, we have redemption value. How are we going to redeem it? We are told at par. At par means 100 naira. So let's complete our table. You can see financial management is not difficult. You just have to understand the concepts, and then you must be, for you to do well in financial management, for you to excel in financial management, you must be able, you must be ready and willing to memorize formulas. If you don't know, if you can't manage, if you can't memorize or master formulas, you can't do much in financial management. The second thing you need to know as far as financial management is concerned is your ability to interpret question. You must know the variables you are looking for you to be able to do justice to your calculation. Otherwise, you'll just be dribbling in one spot. So that's why it is important for you to practice as many questions as possible so that you can gain your confidence. Okay, so let's determine discount factor and then annuity factor. At 10%, annuity factor of year 1 to 2 at 10% will give us 1.736. Discount factor for year 2 at 10% will give us 0.826. We need to multiply cash flow with the discount factor. Here will be 95.3. Then 6 multiplied by 1.736. Multiplied by 1.736 equal 10.4. Let's call it 10.416 or 10.4. Then here will be 82.6. Okay. So to get the NPV, 82.6 plus 10.4 equal then minus 95.3 equal 2.3 minus. So we assume 10%. We got a negative NPV of 2.3. Let's assume a lower discount rate of 5% so that we can get a positive NPV. Okay. So annuity factor of year 1 to 2 at 5%, 1.05 raised to power 2 minus equal minus 1 equal divided by 0.05 equal, okay, that's 1.859. Here is 1.859. Then discount factor for year 2 at 5%. So that's give us 0.907. Okay, so multiply. Here will be 95.3. So 6 multiplied by 1.736. Sorry, 1.859. 859 equal, that's 11.15, 11.2. Then here will be 90.7. So 90.7 plus 11.2 equal minus 95.3 equal 6.6 positive. So we assume 10%, we got a negative NPV of 2.3, we then reduce to 5%, and we got a positive NPV of 6.6. We can then calculate the cost of redeemable debenture. So KD equal to lower discount rate plus NPV of the lower discount rates over NPV of the lower plus NPV of the higher. All multiplied by higher minus the lower discount rates. So KD equal 5% is lower. 6.6 is the NPV of the lower over 6.6 plus 2.3 multiplied by 10 minus 5. What do we have here? Final answer. So 6.6 plus 2.3, 8.9. 6.6 divided by 8.9 equal multiply by 5, then plus 5. That's 8.71%, approximately 9%. Okay, the cost of redeemable debenture is approximately 9%. So step 4, we calculate WACC, estimating WACC. Weighted average cost of capital, denoted as KW. So since we have all the three major sources of long-term financing, so in this case, we are going to use the complete formula. So WACC will be equal to equity value over equity plus preference plus debt multiplied by cost of equity plus value of preference share over total value multiplied by cost of preference share plus debt value over total value multiplied by after tax cost of debt. Okay, so in this case, we need to go and calculate market value of equity, market value of preference share, and the market value of debenture. Working number 5. Market value. Market value of equity. According to the question, are we given number of shares or share capital? Yes, we are given number of shares, 500,000 ordinary shares. So my formula will then be number of shares multiplied by XDIV, share price, 500,000 shares. XDIV share price is 1 naira 5 kobo that we calculated before. Let me confirm. Yes, 1 naira 5 kobo. So when you multiply, this will give us 525,000. 525,000 naira. Then the value of the preference share. In the question, are you given number of preference shares? We are given share capital. Therefore, Market value of preference share will be share capital over nominal price multiplied by XDIV, share price. So P equal to 100,000 naira divided by 1 naira nominal price. XDIV share price is 40 kobo. So this will give us 40,000 naira. Then the market value of the debenture is computed as nominal value multiplied by X interest price over 100 naira. So that value, I will go back to the question. What's the nominal value of the debenture from the balance sheet? Is 200,000 naira. Then the exchange price, we have calculated it to be 95.3. So here is 200,000 naira multiplied by the exchange price of 95.3 naira, 0.30 kobo. So here is 95.3 divided by 100 naira. So this will give us 95.3 divided by 100 equal, then multiply by 200,000. 190,600. 190,600 naira. Then total market value of equity plus preference plus debts, 525,000 plus 40,000 plus 190,600. So total market value will then be equal to 525,000 plus 40,000.
755,600.
755,600. Thank you. 755,600. Okay. Is it 55 or 65? Let me see. Plus 190,600. Okay, 755. Correct. Okay. What else? Now that we have the market value, we can then proceed with our WACC. So equity value is 525,000. Total market value is 755,600. Cost of equity, we calculated 17%. Let me confirm. Step one. Yes, 17%, 15%, then 9%. So here is plus 40,000 over 755,600 multiplied by 15% plus the market value of the debenture, 190,600 over 755,600 multiplied by after-tax cost of debt, which is 9%. No need to do 1 minus tax again. We've already adjusted for tax. So from the left, 525,000 divided by 755,600 equal, then multiply by 17 equal, that's 11.81% plus 40,000 over 755,600 equal, multiply by 15 equal 0.79% plus 190,600 over 755,600 equal, multiply by 9, 2.27. So add it up. Our WACC would then be equal to
14.87.
14.87. Okay, thank you. 14.87%. So we can say WACC is approximately 15%. The weighted average cost of capital of Abakaliki PLC is approximately 15%. And this is the rate. This is the discount rate that Abakaliki should use for its investment opportunity. So that's end of the question. Let me know if you have any question for me. If not, I have 2 more questions to solve. So wherever we stop today, if we're able to solve the remaining 2, fantastic. If not, we push the remaining 1 to the next class. We have done enough for
Hello,
today,
sir.
but yes, talk
Yes,
to me,
sir.
you speaking.
Good
You
evening,
are not
sir.
following the rules. You guys have been breaking the rules since. All right, talk to me.
Okay, sir. So after calculating the cost of weighted average
Take it again.
cost,
The
this
line was breaking.
15%, must we write that narrative
Uh,
we just give
uh, uh, I don't know. Hold on. I don't know whether it's my network
that
or from your end. I can't hear you. The line is breaking.
the investment to be used. Hello,
It's
can
better
you hear me now,
now.
sir? Okay. So I was saying that after calculating the WACC,
Yes.
this 15%, is it
Yes.
must we give that narration that you give just that this is the investment for the company to use the 15%
You know, according
after
to the question, yes, according to the question examiner is asking you, all right, you are asked to advise the management of Abakaliki PLC on the appropriate cost of capital to use for its investment. So after you have calculated, you are supposed to advise, and that's why I was saying that. So you then say Abakaliki PLC should use 15%, should use discount rate of 15%, should use discount rate or cost of capital of 15% to evaluate or to appraise his investments. Okay, to appraise his investment opportunity. That's all. That's all you need to do. All right. I think that's that not say here. Let me get your name correctly. What's her name again? Yes, Oriseneye Oligbago.
Yes, sir.
Hope I pronounce your name very well. Sorry about that.
Is Orisheneye.
Orisheneye. Okay. All right. I will just call you
Thank you.
short. Neye. All right.
Yes.
Okay, so that's that.
So,
That's again,
good day, sir.
you broke the rule. You are supposed to raise your hand. You know the rule already now. No be so. Yeah, go ahead with your question.
Yes, sir. I just wanted to ask a question now about the formula when calculating WACC. How comes the formula changed unlike the previous question?
How does the formula change?
Yes, sir. You know, it was E over E plus P plus D, whereas the other one was the former question, it was equity over equity plus debt.
I should be in the first one we solved, like I mentioned to you, we don't have preference share, we only have equity and debt, isn't it? So if you don't have preference share, there's no need for you to include the middle one. Okay? So there's no point. This middle formula, no need to include it if you don't have preference share in the capital structure. So in the question we solved equity PLC, there was no preference share, and that was why we used only the equity formula for equity, then the debt combined together. Is it clear now?
Yes, sir. Thank you very much.
All right. Okay, so let's have one more illustration. Let's have one more illustration. Let me stop sharing this. I wish I can complete this so that in our next class, we just move to project specific. And these two, okay, let's see. We can do 20 minutes. That's if you cooperate with me. Let me see what's even the question. So let's solve illustration number 10. Illustration number 10, page 46. Illustration number 10, page 46. Who is helping us to read it? Yes. I don't know why some of you are not willing to read today. You are enjoying because I'm the one doing the talking. I wish I can see you physically. All right. Who is helping us to read? Yeah, Tosin, go ahead. Mary.
Toyota Limited and Honda Limited are two companies in the same chemical industry. While Toyota has automated its operations, Honda is just in the process of doing so. Both, however, use good quality materials in their production processes, and their products are well accepted in the market. For the year ended 31st December 2012, each company had net turnover of 4,800,000 naira. The actual kegs of chemicals sold here were Toyota 320,000 and Honda 300,000. The operating statistics for each company for 2012 is as follows. All figures assumed correct.
Thank you.
Then the required assuming that the market values for assuming that the market values of preference shares and debentures are the same as their book values, you are required to advise the management of the two companies on the appropriate cost of capital for the purpose of project valuation.
Thank you very much, Mary. So that is the question. The examiner is asking you to assume that the market values of preference shares and debenture are the same as their book values. Therefore, advise the management of the two companies on the appropriate cost of capital for the purpose of project evaluation. You want to estimate appropriate cost of capital. How are you going to calculate cost of capital based on the scenario given to you? In this question, you are given capital structure. We are given for Toyota, we have ordinary share capital of 1 million naira. We have preference share capital of 400,000. Then we also have debenture of 800,000. Honda has ordinary share capital of 1 million naira, no preference share, then debenture of 1.2 million. So because you are given capital structural information, it means that you are going to calculate traditional WACC. Calculating traditional WACC in the profit or loss account given to us, the operating statistics, you can see the operating figures there, cash flows. However, in this income statement given to, in this operating statistic, we are not given dividend. We are given share price, so be 3 naira 45 kobo for Honda. Sorry, for Toyota, Honda is 70 kobo. So, but you are given ordinary dividend payout ratio to be 50% each. Dividend is not given to you. Therefore, you must be able to think outside the box. What you are looking for. It's not at all time that what you are, the variable you are looking for will be given to you in the question. If it is not given to you directly, there will be information to enable you to estimate what you are looking for. So you know that anytime you want to calculate cost of equity using dividend valuation model, you are supposed to divide dividend by the ex-div share price. So in this question, you are given share price. You are also given dividend payout ratio, but you are not given the amount of dividend paid. Therefore, and you know that dividend is paid out of the earnings, out of the profit after tax. And then in the question, examiner has given you turnover to be 4.8 million. You have been given direct cost or cost of goods sold. Therefore, we are going to estimate profit after tax you are supposed to estimate profit after tax by yourself. So once you estimate your profit after tax, you will pay preference dividend. Then from the balance available to owners, you then pay ordinary dividend. So once you have the ordinary dividend, then you can multiply the payout ratio of 50% on the ordinary dividend. So that will give you the dividend, that will give you the current dividend before you can then calculate your cost of equity. Let me stop sharing this quickly and move to the working notes. Okay. Solution to illustration 10. Page 47, I think. Let me confirm. Page 46. So, to do this, the name of the companies are Toyota and then Honda. Now, like I said, because we want to calculate cost of equity and we are not given dividend, you are only given the dividend payout ratio. In this case, we are going to estimate dividend by ourselves. To do this, first, to get your dividend, you need to prepare the profit or loss accounts to arrive at your profit after tax. Once you get the profit after tax, you can multiply the dividend payout ratio on the profit after tax to have the ordinary dividend. So quickly, The first thing we are going to do is to calculate the profit or loss, or just say income statement. Income statement. We are assuming that our figures are in thousands. That will save time. So here we have Toyota, then Honda. Okay. Edward, what's your question? Talk to me quickly.
Before you continue, sir, this income statement, is it
Yeah.
the beginning of our workings?
Yeah, it's more like we can call it workings, all right? But again, because in the question we are not what we are looking for, we don't have it. Yes, we can, even though it's not the requirements. Of course, it has to be workings. I understand your point, what you are driving at, because all this while, all our calculation, the main calculation has been coming on the first page. Then working will come last. I understand your position. In that case, let me go back so that we are consistent. So that you don't say, oh, maybe I did it that way the other time. So the first page, second page, third page would then be, let me go to fourth page. Let me do it this way. Copy. Okay. Then I'll move to the next one. So this should be sufficient. Okay. Okay. 1, 2, 3 pages should be okay. So what can we start from here? So we need to calculate or prepare income statement. Okay. For Toyota, then Honda, our figures are in thousands to save time. Okay. So to prepare the profit or loss or income statement, we are starting from the turnover. And we have been told that each company achieved a turnover of 4.8 million for the period. So I need cost of sales. Give it to me from the table. What are the line items given? The first item is cost of direct material consumed. I need somebody to be giving me the number. Edwards, or somebody should just give me the number. This
Cost
is
of direct materials consumed
okay.
for Toyota, 1.8 million.
1,800. Next one.
1,950.
Next, after direct material.
Direct labor cost.
Direct labor. What do you have there?
1.2 million.
Next.
Under 450,000.
450. After direct labor, what else?
Production overhead. 400,000.
Production overhead. 400,000.
400,000. 1 million.
1 million.
Yes, sir.
Okay, that's 1,000. Next.
Administrative and selling expenses.
Admin and selling.
420.
How much?
420.
420.
For the two.
Then 420. What else?
Yes, sir. Interest on the
Is that
debentures.
all? No,
Interest
interest
on
will
the
come
venture.
later. So that
Yes,
will
that's
come
all. Then we
later.
have the tax rate.
All right. So let's find the difference. So that will give us profits before interest and tax. So in this case, we can save 4,800 minus 3,820, 3,820 equal 980,000.
Yes, for
Then
Toyota is 980.
4,800 minus that's 2,434,3,820. That should be the same thing. Let me confirm first. Minus
980 as well.
3,820. That's
Under
980.
is 980.
Okay. Now, this is profit before interest and tax. After this, then you charge interest. According to the question, for Toyota, interest is 100,000 under 180,000. So here is 100, then 180,000. Here is 880, then here is 800. This represents profits before tax. From the profit before tax, you are going to charge tax. We are told that tax is 30%.
30%.
Therefore, 880 multiplied by 0.3 equal, that's 264 minus 264. 30% of this is 240.
40.
So here is 576. Okay, then here is 560. So this represents profits after tax. Now, from the profit after tax, you need to pay preference dividend. We pay preference dividend because Toyota has preference share. So you pay preference dividend. According to the question, we are told preference dividend is 10%. 10% on the nominal value. Nominal value is 400,000 naira. So 10% of 400,000 naira will give us 40,000 naira. So here is 400,000 multiplied by 10%. So here will be 40. You have to pay preference dividend before ordinary dividends. So this will be 5. This 880. No, this is not correct. 880 minus, let me see, 880 minus
616.
260. You say it's what?
616.
616, correct.
So that's what I
So
was
this is
using now.
supposed to be 6. Oh, okay. So that should be 616 minus 40. That will give us 576. Then this one is 560. So this is profits attributable to ordinary shareholders. This is profit attributable to ordinary shareholders. From these profits attributable to owners, you are going to pay ordinary dividend. Ordinary dividend. And we are given dividend payout ratio to be 50%. 50% of 576 will give us
It,
two
it,
two what?
88.
88. 288, then 280. So that's what we are looking for. It's because of this dividend we are going through all of this. So this is retained earnings. So we need this dividend to calculate our cost of equity. That's why we are going through all of it, because it wasn't given in the question. So you have to use the information given to you to estimate it. Now that we have the dividend, we can then go ahead to calculate our cost of equity. Okay, so I will then say step 1, calculating cost of equity. Okay, so in the question, there is no growth. We are not given growth rate and we don't have information to estimate growth rates. So that means dividend is constant. So in this case, where dividend is constant, cost of equity equal to the current dividend divided by XDIV, share price, multiplied by 100%. So for Toyota, in the question also, we are not told whether dividend has been paid or not. So since the examiner is silent, you are going to assume that dividend has been paid. Toyota, cost of equity of Toyota will then be equal to the current dividend of 288,000. If I want to use total value, I will just say 288,000 divided by, I need to calculate market value of equity. In fact, let me just go and do that calculation once and for all. Working number 2 now. Market value. Okay. Equity value equal to, in the question, are we given number of shares? Let me confirm. We are given share capital. We don't have number of shares. Therefore, our formula to calculate market value of equity will be share capital divided by nominal value multiplied by XDIV, share price. Equity value will then be equal to, for Toyota, market value of equity of Toyota will be equal to, share capital of Toyota is 1 million naira. Nominal price of Toyota is 1 naira. Share price of Toyota is 3 naira 45 kobo. Therefore, this is 3,450,000 naira. Then for under, share capital of under, according to the question, it is the same 1 million naira, but nominal price is 25 kobo. 1 million over 25 kobo. XDIV share price of Toyota is 70 kobo. 0.70. This will give us 2,800,000. Then we calculate market value of preference share. According to the question, examiner told you should assume market value of preference share and debenture to be their book value. Okay, so no need to do any working on this. I will just say market value of preference share equal to book value. And the book value of the preference share is 400,000 naira. That is for Toyota. Only Toyota has preference share. Then, market value of the debenture, which is D, okay? We are told it's the same thing as the book value, which is equal to, for Toyota, book value of the debenture for Toyota is 800,000, then under 1.2 million. 800,000 under 1,200,000. So we need to get, because of our work, we need to get total market value of equity plus preference plus debts. Toyota, this will be equal to 3,450,000 plus interest of plus a preferential of 400,000. And then the venture value of 800,000. So total would then be equal to 3,450 plus 1,200. Oh, error. 3,450. What's wrong with you? 3,450 plus 1,200. That's 4,650. 4,650,000 is the total market value. Then for under, it will be equal to 2.8 million plus 1.2. No preference share for under. This is equal to 4 million. Okay, so we are done with our workings. Let's then go ahead and complete our calculation. Cost of equity. So if I want to use absolute value. Our dividend, we have calculated dividend for Toyota to be 288,000. So here is 288,000 divided by market value of equity, which is 3,450,000 we calculated, then multiply by 100%. What do we have here? 288 divided by 3,450 equal, multiply by 100% equal 8.35, so approximately 8%. Then for under, cost of equity of under, total dividend of under is 280,000. Market value of equity of under is 2.8 million. Let me confirm that. Market value of equity of under, yes, 2.8. Multiply by 100%. So that will give us 10%. Okay, so step 2. We calculate cost of preference share. Then we ask ourselves, what kind of preference share? Is it redeemable or irredeemable? In the question, you are not given the redemption dates. Therefore, it is irredeemable preference share. So the cost of irredeemable preference share is calculated as fixed dividend over XD share price. So in this case, since we are using absolute value. So here will be market value of preference share multiplied by 100 over 1. So KP for Toyota, dividend is 40,000 naira. Market value of the preference share is 400,000 naira. Multiplied by 100%, that's 10%. So we can change this one too. Since we are using total, we are not using par value. So here will be market value of equity. Total dividend. Here will be total ordinary dividend. Let me just put dividend. Okay. If you use par value, it's the same thing you are still going to get. So no worries. Then step 3. We calculating cost of debenture. What kind of debenture? It has to be irredeemable because we are not given the redemption dates. Irredeemable debenture denoted as KD. Okay. So KD, in the question we are given tax rates. Therefore, the cost of irredeemable debt is computed as fixed interest multiplied by 1 minus tax rates divided by market value of the debt, market value of debenture. So since we are using total value, we are not using par value. So multiply by 100 over 1. For Toyota, interest expense for Toyota is 100,000 naira. Tax rate is 30%. 1 minus 30% will give us 70%. So 0.70. Over market value of the debenture for Toyota, I think it's 800,000. Let me go and confirm. Yes, 800,000 is the market value of the debenture for Toyota. Then 1.2 for Honda. This will be our last illustration today. Here is 800,000. It's almost time to close. Multiply by 100 over 1. So 70 divided by 800. Equal, then multiply by 100%. Equal 8.75. That will give us approximately 9%. Okay. Then for under, let me see if I still have the page. Yes. For under, the market value of the debenture is 1,200,000. 1 minus tax, 0.70. sorry. Is it 1.2? Let me confirm. Interest, 180,000 is the interest. 180,000 over total market value of 1,200,000 multiplied by 100%. So 180,000, 180 multiplied by 0.7 equal, then divided by 1,200 equal, multiplied by 100% equal to 10.5, approximately 11%. Okay? Then finally, we calculate WACC. Step 4, calculating WACC. KW. So to calculate WACC, since we have for Toyota, we have ordinary share capital, preference share capital, and then debenture. So we are going to use the full formula. WACC equal to equity value over equity plus preference plus debt multiplied by cost of equity plus value of the preference share over equity plus preference plus debt multiplied by cost of preference share plus value of the debenture over equity plus preference plus debt, all multiplied by after tax cost of debt. Okay, so for Toyota, it will be equal to, for Toyota, it will be equal to, WACC will be equal to, equity value of Toyota is 3,450,000 over total. Total is 4,650,000 multiplied by cost of equity of Toyota. We calculated 8% for Toyota, 10% for Honda. So multiply by 8. Plus the value of the preference share, 40,000. Is it 400,000? Over total, 4,650. Cost of preference share is 10% for Toyota plus value of the debenture, 800,000 over total, 4,650 multiplied by cost of the debenture for Toyota, 9%. So from the left, this will be equal to 3,450 divided by 4,650 multiplied by cost of equity of 8. That's 5.94. 5.94% plus 400 over 4,650 multiplied by 10 equal to 0.86 plus 800 over 4,650 800 divided by 4,650. What's wrong with this? Equal, multiply by 9. That's 1.55%. When you add it up, so I have 5.94 plus
The answer is 8.35, sir.
8.35.
35.
Final answer, right?
Yes, sir.
Okay, thank you. 8.35. Here is 8.35%. So we can say the WACC of Toyota is approximately 8%. Finally, for Honda, so the WACC of Honda will be equal to equity value of Honda is 2.8 million. Honda does not have preference share, so over total value of 4 million. Multiply by cost of equity of Honda. I think we computed 10%. Let me confirm. Yes, 10%. And then cost of preference, cost of debt of Honda is 11. Okay. Multiply by 10 plus debt value of Honda is 1.2 million over total value of 4 million. Multiply by after-tax cost of debt of 11%. No need to do 1 minus tax again because we've already adjusted for tax. We have adjusted for tax when we are calculating the cost of debt. Remember, we use 1 minus tax here. Okay. So 2,800 over 4,000 equal, multiply by 10, 7%. WACC, here is 7% plus 1,200 divided by 4,000 equal, multiply by 11, 3.3%. So the WACC of Honda is 10.3%, approximately 10%. So this is how to estimate weighted average cost of capital, right on time, 1 minute to the exact time. So let me know if you have any question for me. Majority of you have disappeared in the class. No problem. I understand.
Yeah.
I know Edward is still on. Lekon, Emeka, then Esther, Babalola, Joshua, Mary, Matthew, Michael, Ogini, Olamilekan, Neye, Ramon, Temitope, and okay. Let me know if you have any question for me. This is where we are going to call it a day. So I have one more example to solve under this. And that one involves where you are asked to use book value. Okay? Once we are done with that, we move to project-specific cost of capital. That will be in our next class. Let me know if you have any questions so that we can close the class. We have done well for today. Any question for me? All right. So in the absence of no question, we are going to meet again next week by the grace of God. I want to say good night to all of you. Bye-bye.
Thank you, sir. Good night, sir.
Yeah,
Good
good
night,
night.
sir.
Good
Thank you,
Good
sir.
night. Good night.